Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So, did you know that FHA loans are back and they're better than ever? Stick around. In this video, I'm going to tell you why. So we all know the housing market is improving in the buyer's favor. If you're a buyer out there right now, I would be so excited to get a deal on a house, to get closing costs, to get seller concessions. But what I'm most excited about today is to talk about FHA loans. First and foremost, let me just let the cat out of the bag. In DFW and surrounding counties, FHA has raised their loan limits on a single family home to $531,000. That is insane. That's up from like $460 or $470 from last year. So that's a big deal. Why? Well, the average price of a house in Dallas right now is about $450. So with all the inventory becoming available on the market and FHA buyers now being able to basically get a $550,000 house with as little as 3.5% down, the options are becoming endless. So I'm very thankful for that. So we all know during the COVID run, FHA loans were not getting accepted. These sellers were taking cash offers, conventional only. Even if you were a slam dunk strong FHA buyer, they weren't taking FHA offers at all. Well, not only have they started to take FHA offers again because of the way the market is, now what happens is these buyers can move up in their price points because now you're able to get a loan at $531,000. I think that's just incredible. You know, they keep raising these loan amounts every single year to keep up with the cost of housing. And so if you're an FHA buyer last year or the year before, you were capped out in like the low 400s, and it's hard to find a price in that price point, and it's hard to find a house in that price point as well because, you know, some of those houses are just going too quick and there's too many people. So now they've moved it way up to where, hey, you know, you can get 531. So you can start your shopping, assume you qualify, at $550,000 and do 3.5% down. Now, you can still buy something higher than that if you want to. You just have to make up the difference. So 3.5% down is the minimum, but obviously if you bought a $560,000, $570,000 house and you want to go FHA, you would just have to add that little extra to the down payment. But this really raises the roof for all my FHA people, and I'm super excited about it. Now, little note that's on a single family home. They raised the limits on duplexes to almost $700,000. So if you're trying a house hack, which a lot of people do, they buy a duplex via FHA, they live in one side, they rent out the other side, do 3.5% down, you have the other tenant pay majority or all of your mortgage, and now you've got a $700,000 house you're paying minimal on, getting the equity position from the growth, having the tenant pay off and pay most of the mortgage, and you're sitting pretty as the home continues to appreciate. And then they raised the triplex amount, I think somewhere up in like the $950,000 range. So like I said in the beginning, FHA loans are back. They're better than ever. Single family, duplex, triplex. Now, something else I want to remind everybody about when it comes to FHA loans. FHA loans allow for the owner/seller to contribute up to 6% in closing costs. This is absolutely insane. Not all home loans allow for this much. Conventional loans with less than 10% down only allow the seller to contribute 3%. VA loans 4%, conventional loans with 10% down or more 6%. But all FHA loans, no matter the price point, no matter the style, they allow the seller 6%. So why does that matter? How can that benefit you? So I'm going to dig into that for a minute. We'll use a $550,000 house for an example. So let's say you go out tomorrow, you find a $550,000 place, you're an FHA buyer, you want to do 3.5% down, you make an offer on the property. Well, you know, technically, that seller can pay $30,000 in closing costs for the buyer if they want to. Now, we all know on a $550,000 deal, there's not $30,000 in closing costs. So there's probably about maybe 10, right? So with that extra $20,000, what do? Well, this is where strategically when you talk to myself on our team, we put together a mortgage planning session. What a lot of people like to do is, you know, that extra $10,000 or $15,000 that they have left over, they want to take it off the price of the house. And I say, no, don't do that. If you can get the seller to pay up to 6%, you can use, let's say, $10,000 towards the closing costs, and then the additional $15,000 or $20,000 that you have left over, you need to buy the interest rate down. That's right, buy the interest rate down. FHA interest rates are similar to conventionals. Right now, they're somewhere probably in the mid to high sixes, and no one loves that. I don't either. But if you're an FHA buyer out there and you're buying a higher end home now, and you're able to negotiate in this softer market and get the seller to give you 6% seller concession, and you've got an extra $15,000 or $20,000 left over, you can buy that interest rate down from 6.5%, maybe down to 4.99%. Saves you so much money on the rate, saves you so much money on the payment, and it's a much higher and better use of the money. So something to consider there as well. You can get a ton of seller concession on FHA loans, which gives you, the buyer, a much bigger pile of cash to maximize and use to help you with your financial benefit. Now, a lot of people, when it comes to FHA loans, don't want to stay in the FHA loan forever. Here's the one thing I don't like about FHA loans. A lot of people refer to the monthly mortgage insurance as PMI, and on FHA loans, it's not PMI. It's not private mortgage insurance. It's just called MI. It's mortgage insurance. And unfortunately, on 30-year fixed FHA loans, that MI stays on the loan for life. Where on a conventional loan, when you get to a 20% equity position, it naturally falls off. So, especially if you have a larger home with a larger FHA loan and you put 3.5% down, the monthly MI factor on that is 0.85 of the loan amount. So if you've got a $400-something thousand loan, that can get expensive. Your MI might be $300 plus a month. You combine that with a 6.5 rate, people don't love it. It makes the payment high. But how you offset that is you get those 6% closing costs and you buy that interest rate down from 6.5 to maybe 5% or 4.99. And so what it does, it brings down the debt. It brings down the payment. It brings down the overhead and makes you, as the buyer, feel much better about your overall monthly payment and your financial position. So while I would still encourage people to potentially refinance in the future, even if you're able to buy that rate down to 4.99 or 5% on the FHA loan, it's still potentially a good idea, because when you get to a place to where you have 20% equity or maybe even a little bit less, even if you refinance your natural mortgage on an FHA over to a conventional and the rate is the exact same, if you eliminate that monthly MI of $300, that's still an improvement of $300 a month. So again, refinancing is all about the net tangible benefit to the buyer. There are 20 different net tangible benefits for buyers. I'll cover that in another video. But most people don't stay in an FHA loan forever because of the monthly MI. They usually take an FHA loan up front for one of three reasons: down payment, credit score or credit profile, and then the debt to income, right? FHA allows you to go to a 56% debt to income, where a conventional restricts you at about 45. So it gives you 11% more buying power, and that's a lot in the house. So FHA loans, in my opinion, are not forever loans. They're great starter loans, or they're great loans for people that specifically have to take them. But the benefit is now they've raised them so high to where you can go out and get a huge house with 3.5% down. You won't be priced out of the market. You can get 6% seller concession, buy the interest rate down so the payment is manageable until you get to a place to where you qualify for a conventional loan. The market turns back in everyone's favor and interest rates drop. And then at that point, we got to talk about a strategic play on, hey, where's your equity at? Maybe do we want to do a conventional loan and you're at an 85% loan to value to where you have monthly PMI, but it's only maybe $50 for a year or two. And that still saves you a lot of money. So I always go through that in the strategy sessions with all the clients, but the takeaway here is, again, excited about FHA buyers, excited about these new FHA loan limits, a lot of house, a little money down, a lot of power and a lot of strategy when it comes to buying these properties up in the level of home that you guys can look at now that the new loan limits have gotten so high. And you're able to potentially buy that interest rate down, so that way the combination of the higher interest rate and the monthly MI isn't so bad when you buy it down. It's more manageable temporarily for the time being until you get to that refinance position. So listen, hopefully you found this video helpful. If you did, like, comment, subscribe. Share this with somebody that you know that needs to know this information about FHA loans. And if you want to have a consultation or just have any questions about your financial future, your home loan needs, or just maybe a journey on how to become a homeowner, call us, email us, text us. We're always here to help. Until next time, stay tuned.